This is a much better report than I expected. Seeing a headline number of 0.0 is exciting. There's more reductions in gasoline that we're going to see when we eventually get the August CPI too. I'm much more focused always on the core CPI, that coming in at 0.3. That's the lowest we've seen since September of last year.
This is the first inflation report that we've gotten in a while that shows a decline in the year-over-year gains that we're seeing. So we're talking about a rate of increase getting slower.
How that might influence Fed expectations and the summer rally we've had.
Hey everyone, welcome back to my channel. As you can see, the day prior to the CPI report, the crypto market was plummeting a little, as markets awaited the latest CPI readout. But bullish momentum had once again entered the market after July's CPI report. The Consumer Price Index increased 8.5% from a year earlier, cooling from the 9.1% June advance that was the largest in 4 decades. The market is constantly changing, and there's always stuff going on in it. To know more about the market conditions, stay tuned to the video. As in today's video, we will explore the market, as Chamath Palihapitiya warns about inflation. He'll also touch on some of the current trends and how they might impact the future, so sit back and enjoy. Before diving ahead, don't forget to subscribe to my channel for more videos on crypto and market.
We've never seen a moment in history, in American history, where when CPI has printed successively above 5%, that it got under 5% without Fed funds getting to that same number. So we should all hope that this is the exception that proves the rule, but there's an enormous amount of data that would tell you that we have to take rates to double what the equilibrium rate is thought to be right now. I think you can look at the fact that whenever there's inflation and whenever it's spiked, what has had to happen by the Fed is you have to take rates above that key 5% threshold when CPI is above 5% to break enough demand so that the economy's reset.
After months of scorching inflation, things are finally looking a little more temperate. A big part of it is simply falling gasoline prices. So have we left the headline of scorching inflation behind? Inflation this time around is low, but that doesn't mean the prices are falling too. While a drop in gasoline prices is good news for Americans, their cost of living is still painfully high. Chamath has stated before also that the Fed wants to bring inflation back below 5%, and it may need more aggressive interest rate hikes for that. Last time, the US Fed announced 0.75, taking the benchmark rate to a range of 2.25 to 2.5%, half of what the venture capitalist says we might need to get inflation below 5%. So what could be this time around? It's really hard to say.
There's always stuff going on in markets, and markets represent the collective sum of our wishes and expectations and also the realities.
There's no doubt the Fed is keeping an eagle eye on this. Will it change their rate hike path at this point? Probably not. But let's look at the numbers, because again, inflation is one of the Fed's number one themes, number one concerns. Now, according to the recent New York Federal Reserve survey of consumer expectations, inflation expectation over 12 months is to go 6.8 down to 6.2. That's good. The 3-year inflation outlook went from 3.6 to 3.2, largely because of tumbling gas prices. The Bitcoin price also rose sharply, despite a downtrend in the number of active addresses. At one point, Bitcoin touched the $24,200 level. Ethereum stayed up $1,800K. Let's get into the clip to see what else Chamath has to say on the market conditions. But before going ahead, be sure to give a big thumbs up.
It's always important from my perspective to just take the other side and just intellectually debate with oneself why the other side could be right. So at this point right now, what people would say is, okay, the Fed's going to capitulate at the beginning part of 2023. We have a pretty clear forecast for all the rate increases that have to happen. Everybody's doing the work that's necessary, either raising prices, cutting costs, or doing both, letting people go, et cetera, et cetera. So maybe we're there. Okay, so what's the other side of that? Well, I think, again, as I've stated before, the other side starts with energy. And the reason why I think it's important is that it really is the conflation of an economic system and a political system using an instrument. And if you look inside of what's happening in Europe, there's a lot of complexities here that I think need to get unpacked. So, for example, a couple of days ago, the French government basically said that they're going to start producing less nuclear energy. And you'd say, well, why would they do that? Well, it turns out because, the temperatures are so high, you cannot use the water to cool these nuclear reactors because the exiting water is then so hot that it would actually destroy the ecosystem of the lakes and rivers that they use to feed natural fresh water in to cool the nuclear reactor. Second, because it's so hot, all the rivers are below their natural level. Barges that carry coal and nat gas are getting stuck on the Danube. The Po, which is the longest river in Italy that feeds all the fields, actually is below the level where it can actually offload the water. So farmers can't basically do what they need to do to produce a food supply. So if you play all of that out, you start to see an issue where by, October, November of this year, we're back into the same complexity where energy is the tip of the spear around which everybody starts to debate all of the national security issues that we have to deal with, the Ukraine war, et cetera, et cetera. So I don't know. I mean, you've made a lot of money this year by basically doing the following, which is the exact opposite of everybody else. When everybody else was freaking out, had you bought, you would have made a ton of money. Now everybody's like, it's over. And you can tell that by looking at the VIX, which is the volatility index. We're about to get into the high teens. You have systematically, it has been true that when the VIX is in the teens, you tend to basically buy volatility, which is essentially you get short stocks. And when the VIX is in the 30s, you tend to basically sell volatility and you buy equities because we've hit the bottom. If you've been doing that for the last year, you've made a ton of money. So there you have it. I really don't know what's going to happen from here, but I tend to think things still have to get a lot worse to flush everything through the system.
Chamath talks about his perspective on the other side. He talks about the situation of Europe and how he can see the potential consequences of such a move by October and November. Let's take a look at what's happening in Europe. So the Po, Italy's longest river, is drying up. Due to this, France is curbing nuclear output as Europe's energy crisis worsens. The nuclear issues are not just a problem for France, but for countries such as neighboring Germany, which may have to burn more gas to keep the lights on instead of preserving the fuel in storage for winter. What could be the potential consequences of such moves? Will the Fed capitulate and keep raising interest rates? We have also started to see a little bump in the market, as crypto's most speculative asset, Bitcoin and Ethereum, bounced as well. So, how long will the momentum sustain? Let me know your thoughts in the comments below. Also, don't forget to like, share, and subscribe. I'll see you in my next video. Adios.